Oh my god, the market is crashing or in correction. You look at your portfolio and you see red all over. You turn on CNBC and all you hear on the news is bloodbath everywhere. You get emotional and start thinking to sell your stocks because they're declining rapidly. You start to panic sell. Your thought process goes by something like this. By selling, you can lock in profits on stocks that you are up on. So you sell your winning stocks, but keep the losing stocks in your portfolio. Your way of thinking is that, well, if I don't sell, I have not lost any money. It's paper loss. You hit the send button to place your sell orders. You feel great for taking proactive actions to manage your account. You have stopped the bleeding. Congrats. However, an hour, days, or weeks later, you check the stock that you have sold and saw it rebound by a lot. Now you feel sick to your stomach because it went up so much. And the stock that you kept in your portfolio hasn't gone up and it continues to be in the red. Has this ever happened to you? If so, then you might want to watch this video all the way to the end. I will share with you my top 5 reasons why you should not panic sell during a market downturn or correction, and how to navigate it. I will also share with you what I have been doing. Hopefully, these strategies will help charge up your portfolio. So stick around. Sawadee that's hello in Thai, and welcome to Quantum Finance. My name is Anthony, and I'm a former engineer and data analytics turned entrepreneur and investor. My prior career, I was very successful in creating predictive models for Fortune 500 companies in Silicon Valley using historical data to predict future outcomes. I applied my knowledge to my own portfolio, and in the past 12 months, grew it more than 550%. In this channel, I focus on high growth and disruptive technology stocks for short-term momentum trades and long-term investments. If you're new, welcome. And if you're returning, welcome back and thank you for your support. Please help us grow this channel by hitting the sub button below. Make sure to hit the notification button so you get my latest video update. While you're at it, do hit and like and share the video. I will see you down there. Please note that this video is for entertainment purpose only. I'm not licensed. However, that does not mean that I won't present you with facts and trading ideas that will supercharge up your portfolio. No BS and straight to the point. So let's get right into it. I know it's tempting to sell off stocks that's declining rapidly, but there are many reasons why you should avoid this urge. It's only human nature to want to sell your investment in a down market. Why? That's because most of us are risk adverse and want to avoid losing money. This emotional feeling or fear of loss can lead us to make mistakes. However, when it comes to investing, a logical approach and a long-term mindset are required to outsmart the short-term down markets. Before you decide to sell your investments, consider the following 5 reasons. Number 1. Every recession or downturn in history has bounced back 100%. There has been approximately 33 major recessions in the United States since 1854 until 2018. Of all these recessions, 100% of them have bounced back and surpassed former market highs. Take a look at this chart. On average, the bull market has lasted 9.1 years with an average gain of 480%. Compare this to bear markets, which lasted 1.4 years with an average loss of 41%. So you have about 13.3% chance of getting a market crash or correction for every 10.5 year cycle. What does this mean? Recessions are a natural part of the economy. In fact, some may urge that they're healthy when looking at the economy from a big picture point of view. Statistically speaking, each market downturn has a 100% probability of coming back. Why guarantee a loss or lower returns by panic sell when the statistic is leaning in your favor? For instance, yesterday I recommended my viewers to buy more humble stock, or TSNP, changed to TSPD today and soon will be HMBL. Humble has been in decline for several days, but today it went up a whopping 34%. Even Warren Buffett, perhaps the greatest investor of all time, said, "Be fearful when others are greedy and greedy when others are fearful." Rather than asking whether you should sell your stock in a downturn market, the question you should be asking yourself is, do you still believe in the company you're invested in? Then adjust your portfolio accordingly. Number 2, it is contrary to the common sense of buy low and sell high. Time the market in and of itself is a bad strategy to begin with because it's very difficult to do. But noticing when a stock is on sale can be a great buying opportunity to grow your returns. You probably want to watch my video titled How to Buy in the Dips and Avoid Catching the Falling Knife Part 1 Strategies if you have not already done so. It is common investment knowledge to buy low and sell high. If you decide to panic sell your investment because the market has a bump in the road, you're essentially following the opposite advice and buying high and selling low. In a down market, hold to your previous research on your investment that convinced you to buy in the first place and wait out the storm. This is why I keep stressing in my videos to my viewers to perform their due diligence. In matter of fact, if your passion for your invested companies is still burning and you have a good feeling about it, consider doubling down and buying more while the market is on sale. Number 3, you could miss the opportunity for bigger gains. When is the best time to buy stock? Well, that depends, but in general, when it's undervalued. Imagine if you have Humble stock, which was just around the $1 mark and sold it yesterday just because it dipped to 85 cents. You would have been frustrated this morning to wake up only to see Humble stock bounce back by a whopping 34%. My point is, down market often provide opportunities to buy stocks that have a greater chance of being undervalued. After having done your due diligence on your investments, you may be able to capture even greater returns by purchasing shares in the down market and holding onto your current investment for the long term. Number 4, occasional down markets are actually a healthy economic event. The stock market is indeed in some way a living and growing entity. Considering the following comparison to illustrate an important concept. Say you're a novice runner. You want to improve your health, but you set a goal to run 5 miles as fast as you can on your first day. Do you think this is a realistic goal? In other words, do you think that you would be tired and perhaps take a break here and there for a drink or to catch a breath? Another way to look at this, does a stock only go up in one direction and never come down or go sideways? My point is, even if a top athlete who decides to run for an indefinite length of time, sooner or later will slow down and stop, and perhaps experience greater health issues such as collapse, i.e., the stock that goes up parabolically will likely to crash at some point. In comparison, a runner who runs a distance followed by regular rests, then increase the distance each time can achieve regular and continued growth over time, i.e., stocks that go up, pull back, consolidate and build its base before it repeats itself again and again and again. This is a safer stock to invest. Don't you think? If you're a gearhead or a car person, the same concept is true for shifting gears in a manual transmission car. As the engine speeds up in low gears, it is essential to shift up a gear to slow the engine down while picking up speed. Otherwise, you might burn out the engine while working it too hard in a lower gear. So what's the lesson behind this? Economies function in a similar fashion. In order for continued and intrinsic growth to occur, regular rest or downturn are necessary to limit market bubbles and adjust to intrinsic market prices. So how does this knowledge help you during a down market? Knowing how the market cycle over time can help give you peace of mind that a down market is expected and can often be a healthy event that poses great buying opportunities. Next is number 5, lock in your losses. In most cases where investors feel the emotions urging them to panic sell, they are most often already at a loss in their investment. Thus, they panic sell that they will lose even more. With that in mind, if you decide to panic sell your investment during a down market, you're guaranteeing your loss. Keeping a long-term vision and reminding yourself of why you invested in each company in the first place will help keep the long vision present and avoid selling for a guaranteed loss. When you do your research properly before deciding to invest, you will have reasons to hold on to great companies during down markets, and in a lot of cases, those companies will end up providing double or triple growth in returns. And if you need a good brokerage firm to trade your stock with, especially buying and selling in the pre-markets and after hours, consider Webull. Use my link below in the description to get 2 free stocks when you sign up and deposit $100 into your account. Each stock can be worth up to $2,000 per share. This is a no-brainer and a smart thing to do. The other day, one of our viewers received Google stock value at $1,900. Congrats. So the question now becomes, when should you sell your investment? The short answer is that it's more of a personal decision than a universal strategy. Having said that, refer to your investment research. Comparing it to the company's current state will give you a good idea of how to respond. For instance, ask yourself this question: has something fundamentally changed in the company you invest in that resulted in your feeling that it is no longer a great investment? This may be a red flag to consider selling your investment and choosing a company that better aligns your strategy. According to Warren Buffett, our favorite holding period is forever. He's also been quoted saying, if you don't plan on investing in a company for 10 years, you shouldn't own it for 10 minutes. So here's what I've been doing during this period. I'm actually taking a break to evaluate my portfolio. I'm trimming down where I have too much exposure in. For instance, I was too heavy in the EV sector, so I trimmed the low performers from my portfolio by selling XPeng or XPEV and Switchback or SBE. I also trimmed some NIO and Tesla before the dips. I used those profits to rotate into other sectors where I have limited exposures in. For instance, I recently increased my position in crypto mining companies by picking up more Canaan or CAN, Riot Blockchain or IoT, High Blockchain or HVBFT, etc. And in fintech such as Humble, or now is TSNPD, and soon will be HMBL. I maintain my position in genomics and real estate technology companies such as Biogenomics or BNGO, EXP Holdings or EXPI, Redfin or RDFN, etc. I also trimmed some of those speculative and penny stocks so that I would have about 3 to 5% of my overall portfolio. I'm focusing on companies that have solid revenue, good management team, solid growth, etc. I do think that the market will eventually bottom out. It might trade sideways for a while before resuming upward again. This is because in current market condition, the Fed had printed too much money and released it into the market. The problem is that most people are not spending their money as they're saving it for rainy days. This could have a problem in the future when those money is released into the market. So with any market correction, be mindful that it could be temporary or it could last several days, weeks, or in some cases several months. Hopefully this gives you a better understanding why panic sell could be a bad thing. So stay calm and stay collected. Make your decision based on data and facts and not just on emotions. Best of luck to everyone. So there you have it. If you find the content of value, please leave a comment below. Do share, like, and subscribe if you haven't already done so. Also hit the notification bell for my next video. Now let's go make some moolahs.